Hi, it's Harry Dent. This is the Rant for May the 6th. Note that I am shooting this Thursday after the close of the market. I'm going to be traveling tomorrow. So if the market's down 1,000 points or something tomorrow, note that I will not take that into account in here. So again, interesting times. Our big surprise here, we were expecting the economy to show signs of weakening, expect stocks to keep moving down, and expected the treasury bonds, like the 10 and 30-year treasury bonds and TLT, the 20-year average for that, to be moving up, and it's moved down some. So rates went up just over 3% and up to 3.10% today, settled down at 305. So that's a good sign, but I will admit I was not expecting that. Okay, because most signs are they're slowing, and I think what's happening here, and I just put out in my update to subscribers, the markets don't think the Fed did enough here, because the Fed signal 50 basis point rise, which is on the strong side versus normal quarter increments, but and they're hinting there's going to be probably at least 4 of these, most people think, but the markets are like, you should have done more. So the bond markets are saying inflation's substantial here, and it is, and it's going to stick around if we do not slow this economy. But of course, to slow the economy, stocks will have to come down very substantially since they've been bubbled up again. And ultimately, bonds will see slower growth. And so I've been recommending ZROS and TLT here lately, and they've been beat up a little bit. So I've been telling people, if you're in that, I would hold on here. I think there's support just a couple percent lower, like I think on TLT around 112, and it got to 114 today. So I would hold on to that at this point, and we should see a strong bounce if we get down to there. And there was even a bounce at the end of the day today. We may have already seen the worst, but that's where we're at. We're at this transition, and that's an important thing to understand. The markets are the hardest to kind of get a good hold on near tops and near bottoms. That's when they're the most volatile. When they're going up a long time, you just buy the dips. And when they're going down, you sell the rallies. But when this topping is kind of like back and forth, because it's the bulls are still bullish, but the bears are stepping in harder, and the bears will win the war, but it's volatile first. And same thing in a bottom. It's beaten down so much, the bears still don't give up, and the bulls are starting to jump in, and they'll eventually win. So that's where we're at. So it's still good, as I've said recently. If you're not out of stocks, this is a good time. And if you're into shorting stocks, at this point, any bounce, I think a decent bounce is worth it. And the bonds, I think, are a little bit behind the curve here. I think they should have responded a little more to this strong Fed tightening and knowing that it's going to continue. And I think they will just ahead. So expect these 3.05 to 3.10% 10-year rates to go back down, and that means the bond goes up, and expect stocks to keep going down. So short stocks, long bonds is still the best way to play this downturn. The biggest thing, though, that is still open for me, I would have been a lot happier if we'd have had a first 30 to 40% crash in 2, 3, 4 months. Okay, well we're getting 5 months into this now, 4.5, and it has not done that. Okay, the Nasdaq's been down 23% or so. Okay, so that's not enough to say definitively that was a top, but the fact that markets are rolling over now again after a bounce shows there's still weakness. And I think the smart money is seeing that. So as long as the markets keep going down, the odds of that top on January 4th, and remember, that was after a long series of tops all the way back to early 2021, and one global and stock index after the next. That was the last to go, basically, was the FTSE in London and the S&P here were the last 2 very broad, most stable indexes to go. And I do think that was a top increasingly, but still can't confirm it. This next wave down, I think, will confirm that. And at this point, my favored scenario, and again, it's still not clear, is that we're in a 3rd wave down into May. We'll get a bounce, and we'll see a 5th wave down into probably, let's say, about mid-July. And that should take us down to 40% for a first crash. And that will then compare with other first crashes, except that it took 6 months to get there instead of 2, 3, or 4. Okay, so that's just what I'm looking at now. And again, this is the time to keep looking for updates, and it's a time for people who people on our free list really should be getting on our paid newsletter at this point. Things are getting serious. And again, this should be the most serious crash. And again, it's a little open because governments are going to keep fighting it. It may not be quite as bad as 29, 32 or whatever, but this is going to be the crash of our lifetimes, okay? Now and for decades in the future and decades past. So this is something to take seriously. And I think this is kind of here starting to be the last good chance to get out of stocks and to get positioned in the highest quality 10 and 30-year bonds, TLT, averaging 20-year treasuries, and ZROZ, less liquid, but averaging 25-year and a little more kick. Those are still the best places to be, and there's nothing wrong with having a good bit of cash. Just because no matter what happens, that's gonna improve in value if all other financial assets are falling. It's gonna preserve your wealth. So again, here's the update here, and keep listening, folks. I think the fireworks are starting to go off and will continue to go off into this year. And remember, my worst cycle year after 1982, 1932, and 42 is this 90-year cycle into the end of 2022. If we do not see at least the beginning of a major crash, which means 40% or more by then something has changed, and we'll have to reconsider a lot of things. But I do think that we are going to see a lot more on the downside by the end of this year. Thanks for listening.